Live from Bloomberg's World Headquarters in Midtown Manhattan, I'm Matt Miller.
And I'm Kailey Leinz. Welcome to Bloomberg Crypto, a look at the people, transactions, and technology shaping the world of decentralized finance.
Coming up, Kim Kardashian's crypto settlement is a reminder to other celebrities that regulators are watching. We'll discuss with former CFTC official Charley Cooper as the race to regulate ramps up.
And following the big money, we'll speak with Tal Cohen of Nasdaq about the stock exchange's first major push into crypto.
Plus, tales from the crypt. More than 12,000 digital coins have turned into zombies during this year's market slump. We'll dig into that data.
All right, all of that is ahead, but first we want to get to some major market news which broke in the last hour. Elon Musk is proposing to proceed with his deal to buy Twitter for the original offer price of $54.20 a share. For more, we're joined by Bloomberg's Ed Ledlow. Ed, Twitter shares halted, but they spiked up more in the direction of that offer price on this news.
Yeah, according to sources, Elon Musk sent a letter to Twitter proposing they proceed with a $54.20 per share offer, the same as the offer made in April. Musk has spent months trying to walk away from this deal. He officially tried to terminate in July, and we were heading towards a trial in Delaware in the Chancery Court on October 17th. On Monday of this week, we understand that Twitter's CEO, Parag Agrawal, was deposed as part of the discovery process in the lead up to that trial, and Musk himself was due to be deposed later this week as part of the discovery process moving towards that trial. The market was assigning high probability, high odds that the judge in this case, Kathleen St. Jude McCormick of the Chancery, would likely enforce Musk to buy the company at the originally proposed price. His grievance was the level of bots on the platform and also the way that Twitter's company was run after his offer was made. He would have to prove material adverse effect. In other words, that Twitter withheld information so substantial that it blew a hole in the entire deal, where Twitter was actually suing Musk, basically just to say, you're a big boy, you signed a contract, we're holding you to the original terms of the deal. And as we got closer to the trial, the market said, we think that the deal will go through. This is an unexpected development, and as you say, a huge spike in the stock, as much as 18%, closing the spread, and now we're halted, awaiting more news.
Yeah, stock is halted. As you say, it's currently up 12 2/3%, still down about 18 for the year. Ed, thanks so much for joining us. Bloomberg's Ed Ludlow there with the details of Elon Musk agreeing to buy Twitter for the original price of $54.20. Meanwhile, a cloud of regulatory uncertainty continues to loom over the crypto industry, but celebrities looking to make a quick buck shilling currencies got a reminder this week that regulators are watching. Kim Kardashian will pay almost $1.3 million to settle SEC allegations that she illegally touted a crypto security. Joining us for more is Emily Nicole, a Bloomberg Crypto reporter. So, Emily, was this a surprising move from the SEC?
Definitely not a surprise, I think. The SEC has incredibly ramped up its enforcement activity over the last year. It nearly doubled the size of its crypto unit in May. And so targeting someone like Kim Kardashian is really the best way for the SEC to get the message out that trying to shill crypto, as they like to say in the industry, definitely comes with consequences, particularly if the price of that token then plummets afterwards.
Well, and we know that Kim K isn't the only celebrity who is involved in these kind of affiliations. What does this mean for celebrities more broadly with these kind of roles and who have maybe gotten paid to do something similar?
It sends a signal that they definitely need to be a lot more careful about the way that they talk about crypto in particular. The idea that, whether crypto is a security or not is still under debate, but in the eyes of the SEC anyway, Ethereum Max definitely counted under that banner. And so the use of, hashtag ad on your Instagram post simply isn't enough. When it comes to securities, you also need to be posting things like, how much you were paid, declaring that you were indeed paid to promote that token. And so other crypto projects that celebrities are now being paid to tout, mostly NFT collections as well, they'll all be coming under certain scrutiny, and celebrities will probably be a lot more wary. They don't want to be paying $1 million in penalties either.
All right, Bloomberg's Emily Nicole reporting from London. Thank you so much. And as the regulatory scrutiny on crypto grows, billionaire Sam Bankman-Fried told us last week that he's hopeful about where the regulatory process has gone and the progress that has been made so far.
You look at where we were a year ago with very little going on the regulatory side. You look today where there are proposals in Congress to provide clarity for spot cryptocurrency assets, where the SEC and CFTC are both working on regimes, where you have stablecoin bills going through. It is really a world of difference. And, I agree that there needs to be clear federal oversight here to really protect consumers, and at the same time, to be able to provide, clarity for the industry to operate, in the country. And I think we're making a lot of progress on both those fronts.
Joining us now for another take is Charley Cooper, a former CFTC official who is now managing director at enterprise blockchain firm R3. Charley, nice to see you again. Thank you so much for being here. What's your assessment of the progress we've made on the regulatory front, and how much further the U.S. has to go?
Well, I think Sam Bankman-Fried said it well, that there's a lot happening, which is encouraging. You're seeing engagement not just here in the U.S., but in Europe and in Asia, in a whole host of forms, everything from central bank digital currencies to digital assets to the role of stablecoins, and ultimately the crypto stuff, which is what I think gets a lot of people excited and what got Kim Kardashian into trouble. Now, what I would also say, though, is a lot of the work that's been going on in Washington is still what I would call suggestive or recommendations. A lot of what President Biden's team put together over the last 6 months were research reports. They were suggestions about what could be done better, but they didn't actually act in any specific way to issue regulations. But one interesting thing that they did do is they made a pretty clear message to Congress to tell them to get on the ball and get rolling. And that wasn't just idle rhetoric. One of the things that you need to look at under Treasury regulations after Dodd-Frank is that FSOC, which is concerned with financial stability, has certain power in the regulatory realm to act if Congress decides not to. And if they make a determination that some of the firms that are trading in crypto or making payments or settling and clearing your crypto are systemically important or are acting as financial institutions, they can step in. So part of what I think we saw this week and last week was the Biden administration telling Congress, you're making progress. We're glad to see it, but there's more to be done, and don't slow down.
What are the main concerns for the Biden administration and for Washington? I mean, there have been problems. Everyone points out the money laundering issue and the fraud issue, obviously, especially around DeFi. There was a study last month that showed the energy usage is a problem. It's almost 1% of U.S. energy usage just to mine coins. So what are they looking at?
Well, actually, I think it's a combination of all of what you said. First and foremost, I think there's a concern for consumer protection. A lot of what the federal regulatory agencies are worried about, and what they're worried about in the case of Kim Kardashian, was the fact that average Americans sitting out there taking their cues from social media were making investments in stuff they don't understand and stood to lose a lot of their money, in some cases substantial parts of their net worth. I think from the FSOC standpoint, they're looking at financial stability more broadly. What growing part of the economy, and at what point does this crypto piece become such a large part of the economy that it poses a systemic risk to what we consider the more traditional economy? FSOC wouldn't be issuing reports about systemic risk because they didn't see that coming. And the third piece that you mentioned,
they'd have to go a lot further than this, right? I mean,
no doubt.
Even at its height, it was worth, what, $2 trillion in market cap?
Yeah. No, this is, I think, the Biden administration getting out ahead of it, seeing that it's coming. It's not there yet, and I don't think the crypto crash the last 6 months posed a systemic threat. But 2 to 3 to 4 years down the road, if it keeps growing exponentially, it does become a potential problem. And the third piece is the environmental concerns that you raise. The amount of computing power that goes into some of these cryptocurrencies and proof of work is astronomical in terms of the damage that it can do to the environment. And therefore, a smaller footprint is very much in line, smaller environmental footprint is very much in line with the Biden administration's efforts in environmentalism.
Hence Ether moving to proof of stake and trying to solve some of that problem. You were talking about CBDCs and the idea of things that potentially could be coming but are not here yet. We heard from the Dallas Fed president, Lori Logan, speaking earlier today at an event about that. Just take a listen to what she had to say.
In the U.S., no decision has been made on whether to create a CBDC, and the Federal Reserve has indicated that issuance of a CBDC would need clear support from the executive branch and from Congress. Additionally, it's important to assess what benefits a CBDC could bring over and above the benefits of faster payments through FedNow.
So it kind of feels like they're not really in too much of a rush on this. What happens if the U.S. drags its feet too long?
Well, you're right. They're not in too much of a rush. And I guess the question they have to ask themselves is a delay a problem for them? I will tell you that the longer that they wait, the more the market grows for so-called stablecoins. And when I talk about stablecoins here, I'm talking about reserve-backed, more legitimate stablecoins than the algorithmic ones, potentially. We're not talking about
Tether,
the type
not
of,
Luna.
Definitely not Luna,
Yes.
right? The U.S. terror collapse of a few months ago was a remarkable reminder that when somebody tells you that something is algorithmically backed up by crypto and is going to model the U.S. dollar, that absolutely is not the case. In fact, one of the draft bills on Congress right now is talking about stablecoins, that algo stablecoins are not okay, at least for now. But the more that the Fed delays on central bank digital currencies, the more I think that vacuum will be filled by potential stablecoins, which will allow mainstream finance, more traditional players, to get in and out of crypto markets in a meaningful way that otherwise they would have to wait for central bank digital currencies. So until then, I think this delay is meaningful for the stablecoin business.
All right, Charlie, great getting in the studio. Thanks so much for joining us. Charley Cooper there, managing director at enterprise blockchain firm R3. Really appreciate your time.
All right, well, coming up, we're going to talk about Wall Street's crypto push. Tal Cohen, head of North American markets at Nasdaq, will be joining us next.
And trapped in zombie trading limbo, why over 12,000 digital coins may be as good as dead.
And of course, to access all of the latest data and news on crypto, you can check out CRYP Go on the Bloomberg terminal. Also on the Bloomberg terminal, you can check out the pricing for both Twitter and Tesla after the news that Elon Musk is proposing to go ahead with that $54.20 per share offer price to buy Twitter. Right now, Twitter shares are still halted. They spiked about 13%. Tesla shares, though, right around session lows. At this point, only 0.9% higher. This is Bloomberg.
We think that blockchain rails have a lot, frankly, to offer traditional finance when you look at the settlement issues that we've seen in in the financial ecosystem, and so I think combining together a lot of the technology from the crypto ecosystem with the with products we want from traditional finance, at least we think it's a really promising future.
That was FTX CEO Sam Bankman-Fried speaking with us here on Bloomberg Crypto last week. As Wall Street has increasingly toyed with digital asset ventures, there are now questions looming around how blockchain will change the way companies and investors raise capital. You already see the changes brewing in the market. Bloomberg's Charley Cooper has been tracking them all. Charley, just describe this evolution for us.
You think about it, back from initial coin offerings to NFTs, non-fungible tokens, crypto markets have for years been utilizing blockchain technology to raise funds all outside the traditional capital markets. And even during a crypto winter, we've seen large investors from Greylock and Temasek and Andreessen Horowitz who have poured money into firms and are fueling the NFT market in particular. And Cowen Digital estimates that noteworthy NFT investments and NFT transactions have totaled $1.9 billion year to date. Now, listen, that's about $500 million less than what was raised in all of last year, but you can see the transactions have been holding up, highlighting the promise of NFTs in particular as a vehicle. Listen, it's still a small fraction of the overall IPO market, which has been seeing a tremendous downturn this year, even with large IPOs grinding to what feels like a halt. The market has still priced in more than $70 billion worth of deals, according to Bloomberg data. But with that said, Cowen sees the potential for blockchain to make it easier for early stage companies to go public. David Kroger, a digital data scientist at the firm, said there are huge expenses associated with IPOs that make it nearly impossible for early stage companies to access public markets, something that NFTs and ICOs could solve. But tokenization could offer more liquidity and also broader access for investors who aren't institutions. With that said, there are still many regulatory hurdles, he said. With Nasdaq being the latest Wall Street firm to embrace digital assets, what's interesting is how a big regulated U.S. exchange known for its ability to adapt to new capital markets technologies that has ranged from direct listings to now seeking to offer custody services for crypto firms, how it can mold to what has recently been seen as a competitor to traditional listings. But remember, it was only a couple of months ago that Nasdaq CEO Adena Friedman told me that it's possible for every asset on the planet to be digitized over the coming decades.
All right, Charley, thanks so much for joining us. Really appreciate the overview. Joining us now is Tal Cohen, Executive Vice President and Head of North American Markets at Nasdaq. It's great to get you on the program, Tal. Thanks so much for joining us. Let me just get an overview of your plans. I mean, you're starting with custody. Why there, and what's next?
Yeah, so we have an aspiration to build a world-class digital asset business, and we're starting with custody because we think we have a real advantage and a right to win around custody. But more importantly, we can be a trusted, neutral, independent provider of those capabilities to institutions. So today, as institutions look at existing custody solutions, we noted that there were certain trade-offs that they had to make between security and access, for instance. And that's within the construct of the cold and hot wallet that exists. So we took a look at it with fresh eyes, understanding institutional needs. And what we've done is really ensure that we can provide the same level of security all the time with a high level of access all the time. And that opens us up to a number of different use cases for institutions. And then when you add our heritage in creating and developing scalable and resilient solutions for customers, well, the downturn in the market and the volatility in the market, customers are seeing the value of that resiliency and the value of scalable solutions. So we think we're really excited about institutions' interest around what we're building. And we think that it's going to be well situated and well suited for the needs they currently have.
When could we see Nasdaq launch a crypto exchange, and what would you need to see to get you to that point?
So today we're focused on custody. That's foundational. We think if you can keep people's assets, they'll trust you to do everything else afterwards. So we'll start with the foundational piece. We'll build up from there. We'll have execution capabilities because it's not just the safekeeping. It's the movement and transfer of those assets that we want to facilitate. And then over time, as we have more regulatory clarity and we see greater institutional adoption, those are discussions we're happy to have. But right now, on the retail side, the market is fairly saturated. There's a number of exchanges servicing the retail customer base. I think our focus is on where the demand is and where the opportunity is. And we think it's just massive on the custody side and the execution side.
In terms of trading, Nasdaq and a lot of other firms make money on the data, but in this new decentralized world, a lot of that's going to go for free. Our BN colleagues point out that there's a decentralized market data provider like the Pyth network. Will you be sharing your data with them? Does that interest you at all, or do you want to keep it for yourself?
Data always interests us, but from the perspective of where we can add value, where we can provide value. And there's a lot of content, a lot of data that the blockchain provides. So we'll look at opportunities to create derived data products and other value that enhances the transparency and the liquidity and the interaction that customers have with that market. But our aspirations right now, because like I said before, the addressable market on just the custody and the execution side are so attractive to us. So that's where our focus is. That's where we think we can really add value and accelerate institutional adoption, which from our perspective has still been strong even through this downturn.
Well, and of course, as you build this out, you need a team. I believe you have set a goal of hiring 40 by the end of the year. Where are you on that journey? And are you having any difficulty having interest in crypto-related jobs in the middle of a crypto winter?
No, not really. I think the Nasdaq brand is a really strong brand. For a traditional finance company, I think we have a pretty cool brand. People know that we're cutting edge when it comes to technology and innovation. So it was not hard to attract talent, number one. Number two, culturally, we have the mindset that we never want to stay put. We always want to push the envelope and make sure that we do so under the auspices of being highly regulated, working very closely with regulators, and developing solutions for the institutional community. So we've hired somewhat around like 10 to 15 people from the start of this year, and we started with no code, and we're now at an alpha product. So I'm really proud of the team. We continue to bring in great people, and we continue to work with the likes of New York DFS to obtain our trust license because we'll do it under a regulatory license. And we're just really excited about, off the back of our announcement, the kind of reaction that traditional Wall Street gave us, as well as the crypto economy. We've been really warmly received from both sides, and we're really excited about being able to provide those solutions.
All right, Tal Cohen of Nasdaq, thank you so much for joining us. Now, we quickly want to get a check on two stocks which are making news today as well. Elon Musk proposing to Twitter to go ahead with the $54.20 per share deal he had originally offered them back in April. Twitter shares are still halted, but when they were halted, they were up about 13%. Tesla shares, meanwhile, have given up basically all of the gain they had seen earlier today. Right now, Tesla is only up about 0.3%. We will continue to follow this story for you right here on Bloomberg.
This is Bloomberg Crypto. I'm Matt Miller with Kailey Leinz. Now, the CEO of Tesla, Elon Musk, is agreeing to buy Twitter for the original offer price of $54.20 a share. That potentially ends one of the most contentious acquisitions in recent history. Mandeep Singh, Bloomberg Intelligence senior tech analyst, joins us now for more. Mandeep, what does Musk have to do now? I mean, if he agrees, does the court battle go away? Does he just have to pay up? Do they just need to find a closing date?
Yes, and looks like we are going ahead with the original terms, the $44 billion takeover price that was agreed upon. And it seems like they're going to move ahead quickly from this point on. The question still is, what are they going to do once the company is private? Because we know, top line has decelerated, and he has talked about bots, he has talked about subscriptions. And first thing is he has to find someone, from the ranks, social media companies to run the company, because most likely he's not going to do it himself.
Well, and obviously he already runs other companies, one of them being Tesla. What does this mean for Tesla, Mandeep?
Well, so the good thing, I think what has happened over the last 3 months is the sentiment around Tesla seems to be getting better and better in terms of, what Tesla could do on the autonomy side. And just overall, I think that is what has made it easy for him to finance the transaction and really sell his stock to make up for, the leftover amount. We estimated around 10 billion, where he still had to raise that 10 billion. And he has already sold a lot of his stock since that 3-month period. So clearly, I think that is what has helped him kind of feel comfortable with that 44 billion price tag. And now that he has the money, he can close it out.
Yeah, well, we have definitely seen Tesla shares reacting big time to this news. They were up about 6.2% at one point in the session, now only up about 0.4%. Thank you so much to Mandeep Singh of Bloomberg Intelligence.
And of course, they are actually trading. Twitter is still halted right now at $47.93. It's a gain of about 13%. It has been up about 18%. We're still waiting for the stock to trade again.
All right, well, join us here on Bloomberg Crypto next week. Tuesday at 1 p.m., we'll be speaking with the crypto analyst from ARK Investment Management. This is Bloomberg.